welcome back to another episode of the ICIS Energy Foresight podcast. Today with me I have Matt Jones and Andreas Schroeder, and we're talking about the next winter with a winter outlook. So what is going to happen on the energy front and what are the major risks? Hi guys.
Hey, Matteo. Hi there.
So we have just entered into a new gas year, and as we are recording this, it's the beginning of October, and we have also just released our winter outlook, energy winter outlook. And like in 2023, Europe is approaching the winter season in, I can say, healthy conditions, right? Gas storage levels were already above 90% at the end of summer. LNG availability on the global market seems to be pretty healthy as well. And as we have discussed several times, gas demand is not really picking up. Andreas, can we say that the winter looks pretty fine at this stage?
It is interesting indeed. All fundamentals are pointing to a bearish price pattern, yet the prices are still at the upper end of the ceilings of the corridors that we consider. And it's a bit weird. So storage sites are super full, 94% in the EU. It's very high. We have weak gas demand in Europe, very weak power gas demand. Margins are negative all along the curve. We have minus 5% industrial production, especially in Germany, which is dragging down the whole European average. And so there's a few signs of recovery, but overall, gas demand remains weak. A sign of recovery from industrial production and some behavioral change on the residential commercial complex as well, with households saving a bit less energy. So that's the only thing that is really pointing to bullish risk at this stage. And yeah, as you said, LNG arrivals are a bit lower this year, 13% this year compared to last year, according to ICIS data. And Asia is picking up, so it's doing the inverse of what Europe does. Now, there's no risk, so we should still consider some risks which are driving prices to the upper end of the corridor. So we are touching oil parity with our gas prices in Europe and Asian prices as well. And why is that? Well, it's mostly because of geopolitical risks. So we know there is the Ukraine transit issue expiring on the 1st of January. So no one knows will the Ukraine transit continue. Although it does not have a big volumetric impact, it does at least have a local impact on Europe, and it drives the sentiment of the market, as does the Israeli conflict, with Israel being a gas producer and Egypt being shifting from gas exporter to importer. And so this has repercussions for the global market. And then we should not forget there's a cold winter risk as well. And that's something we have calculated with our analysts. So a cold winter can easily swing demand by 20 BCM or so per year. And that's having a price impact of at least €4 per megawatt hour in our scenarios. And this is what we can fundamentally explain, plus any sentiment-driven trades. So there is some risk we should consider.
That's very interesting. So there's a price premium there, which is currently linked to geopolitical events, which may even be higher if we factor in the weather component, right? Like a cold winter. And what might be different this year compared to the previous two is exactly that, where while in 2022 and 2023 we recorded milder than average temperatures, this year is it going to be the same? No, that's an open question. And Matt, when we look at power, geopolitics play less of a role to a certain extent. I know it's probably a bold assumption there, but what we have discussed recently, especially on the power side, is the role of renewables, and obviously they're less affected by geopolitics, but they are strongly affected by the weather side. So we know that solar will progressively disappear from the electricity mix. That's pretty predictable to a certain extent. And nuclear and hydro are set to produce at normal levels, or at least that's what we get in terms of forward-looking view or what has been happening so far. If we exclude gas, which is an incognito as an open issue, as Andreas said, what are the other major issues that are affecting the power market? What are the major risks that we should consider and look at?
Sure. I think pretty similar to gas, that the fundamental perspective is looking pretty comfortable as we head into the winter. So as you say, hydro and nuclear looking okay. 10% increase in solar and wind generation year on year is what we're expecting, and the sluggish demand growth that we've also got on power like gas. So about 2.2% higher compared to last winter. So that means that we expect this winter fossil generation to be pretty similar to where it was last winter, about 1.2% higher in our base case. So again, the fundamentals point to a pretty comfortable position. The biggest risk, as Andreas said, for gas is on the weather side. So we see a cold scenario could push prices up by as much as 13.5%, or indeed down by as much as 13.5% if we were to get particularly mild weather. And that's coming from an impact not just on the demand side, but also on the supply side. So the more renewables, particularly wind, that Europe installs, the more that leads to potential variability in the amount of wind generation. So typically colder weather is stiller weather. But then we can't really just divorce this from what happens on the gas side, particularly over the winter period. Gas plants are the ones in Europe that are setting the price in the vast majority of hours in almost all markets. So what happens to the gas price will be the key driver of what happens to the power price over the winter period. And then the third one to consider is the carbon price. That's tending to follow what's happened on gas in recent months and is likely to continue. And therefore, you can get this double impact of gas prices going up and that also pushing up carbon prices, or vice versa if gas was to fall further.
Yeah, that is pretty interesting. And, there are all these moving pieces, which are obviously difficult to predict and difficult to forecast. If we look at the structural elements, Matt, and if we take, for example, Germany, and Andreas alluded to in terms of obviously the economic recovery, but we look at Germany more from a structural point of view. We know that the country is going to phase out almost 11 gigawatt of coal and lignite capacity next year. And many expect these to be a massive trigger for more gas generation coming into the mix and replacing coal and lignite. Is this the case? And if that's the case, what is the impact on the German power price?
Yes, it's an interesting question. As you say, you've got 11 gigawatts of coal and lignite that's gone from the merit order compared to last winter, which in theory should lead to more gas-fired generation. But interestingly, our models suggest that isn't the case, that we'll get pretty similar, if not a little bit less gas in Germany compared to last winter. Part of the reason is that some of the coal and lignite that's closed was pretty old and inefficient and to the right-hand side of the merit order, so wouldn't have produced anyway. Partly the solar and wind increase that we've talked about, that helps to displace gas-fired generation. But mainly it's a trend of Germany importing more instead of producing domestically. And it's one of those trends that we've written quite a lot about in the last year or two, where Germany is effectively going from one of, if not the largest export market in Europe to the largest import market within the space of 2 or 3 years because of the phase out of nuclear and now of coal and lignite. So it's part of that broader trend that's really changing the market in Central West Europe because the role that Germany will play is so different to what it did play a couple of years ago.
It is a super interesting topic. Obviously, Germany is the biggest player in the European market, and we know that it's going to major structural shifts. And if we look at, there's coal and lignite component, but there is also the gas component, which, Germany is effectively has already moved away from pipe gas to LNG, and has over the past 2 years have massively ramped up the LNG import capacity. In theory, that Germany should be able to offset coal and lignite generation with more gas in the form of liquid gas, LNG. This is probably not happening in the full extent, as you just said, Matt, and the way we are forecasting it. But can we say that potentially, and this is a question for you, Andreas, is Germany is the new player in the LNG market and is effectively competing against China and other Asian markets, and potentially will play a massive role over the coming years?
So Germany is competing with China indeed. Yet it's a very small player. It's a nascent player on the market, the new kid in town, so to say. And it's a small player. So ICS data shows that LNG imports into Germany have been around 6 BCM last year. That's a small fraction of German gas demand. That is an even smaller fraction of European LNG imports, which have been around 115 BCM per year last year. So Germany is too small to be the big player, but it plans to expand its regas import capacity to around 50 BCM per year. So if all of that materializes, then Germany can become a respected player on the LNG market, yet it's by far not the biggest one. And compare that to China, which alone imports already more than 100 BCM, 110 this year. It pales in comparison. So Germany is not the biggest player. And also it's interesting to observe, as ICS data shows, German import capacity is ramping up, but the imports itself are not picking up as strongly. So the utilization of those terminals goes a bit lower. And it's questionable whether Germany really needs all of those capacities going forward, given that its gas demand is, at least according to political plans, it's shrinking over time.
Yeah, and over the long term, obviously, there's a big open question around a lot of on the gas side, a lot of the long-term decisions, whether more infrastructure or whether more are related to contracts, which are still on the table. But if we move again to the next winter, and this final question for you both. We have discussed about a lot of the risks that we are monitoring, and we keep monitoring and try to obviously provide forecasts and sensitivities to our companies, to our customers. But what are the main risks that nobody is talking about?
So on the gas market, some topics that no one at the moment talks about is Russia swamping the gas market as it did before the Ukraine war. But it has the potential to really swamp the market and then drive prices lower for a very long time, given its sheer amount of gas it has and the pipelines which still exist. So that is a scenario in case there is a ceasefire or some agreement with Russia, it could easily flood the European market. And that's a bearish scenario that no one talks about at the moment. A bullish scenario, though, is another black swan on unknown issue, like coal to gas switching in Asia. Look at China, look at India, countries with huge coal power fleets. And they are so big that just a bit of switching from coal to gas can have huge implications for the global gas markets and LNG markets. So if you switch some of the capacity in India and China from coal to gas, this can have very strong impacts on the market. Yet it's a topic that it's not really talked about a lot at the market.
And on the power side, Matt?
I'll give you two. So, one is the threat of security of supply as we phase out so much capacity. So I don't think it's necessarily a threat for this winter. But if you look at, say, price spikes in Eastern Europe in recent months, the circumstances there weren't that dramatic in terms of what led them to prices spiking. It wasn't sort of a once in 100-year event. And if you consider how much coal and lignite is being phased out in Central and Eastern Europe in the next, say, 5 years, will there be enough firm capacity to ensure that we don't get further price spikes or security concerns? So that's a power-specific one. A geopolitical one would be China and Taiwan. No one's been talking about that recently. It's all been Ukraine and the Middle East. And I think it's unlikely that we'll see anything happen this year. But with the US election coming up and potential distraction that could happen from the result there, that it's not completely beyond the realms of possibility that that China uses that as a pretext for some movement in Taiwan.
Yeah, that is actually quite true, and we'll probably see and understand more of it over the next few weeks when the US elections are over. It was super interesting. Thanks both again. And as always, if you want to know more about Energy Foresight, please reach out or visit our website, icas.com. And thanks again, both, and to the next time.
Bye.
Thanks. Bye.